So it's a nice morning. We meet again for a session of advanced financial reporting. So for today, we are going to talk about the deferred taxes. That is according to International Accounting Standards 12. So for these deferred taxes, we say that deferred taxes is all about provision for future taxes. So organizations are supposed to make for the income taxes, that is to pay the relevant income taxes. So the income taxes concerns the current tax and the deferred tax. So what about these deferred taxes? So I've already mentioned that the deferred taxes concerns provision for future taxes. Like now the tax of the next financial years, we make a provision today. So we said that in order to determine deferred taxes, we always take temporary differences. So we always say that deferred taxes, so the deferred taxes is all about temporary difference. We say that it's equal to temporary differences. Temporary differences we multiply with the tax rate. We multiply with the tax rate. And remember that in order to get the temporary difference, you must have a carrying amount. You minus with the tax base. Carrying amount and the tax base. So this carrying amount is again called net book value, and this one is called written down value. So of which carrying amount is all about cost minus accumulated depreciation, minus the accumulated depreciation. Then tax base is all about the cost, you minus accumulated capital allowance, you minus the accumulated capital allowance. That is what you need to know. Then another thing you need to know is that the temporal differences, we have various types of these temporal differences. So we have types of temporary differences. So the types of temporal differences, whereby I said we have the taxable temporal differences, taxable temporary differences. So this is all about taxable temporal differences is when the carrying amount is greater than the tax base. The carrying amount is greater than the tax base. So this is a positive temporal difference, and it leads to deferred tax liability. So leads to deferred tax liability, leads to deferred tax liability. Then we have another type of temporal difference, which is called deductible. Deductible. So deductible temporary difference. Deductible temporary difference. So deductible temporary difference, these are about when the carrying amount is less than the tax base. The carrying amount is less than the tax base. And that is a negative temporal difference, a negative temporal difference. And it leads to deferred tax asset. So that is what you need to know when you are doing deferred tax. It's all about temporal difference times tax rate. How do you get temporal difference? You take the carrying amount minus the tax base. How do you get the carrying amount? Cost minus accumulated depreciation. How do you get the tax base? Cost minus accumulated capital allowance. Types of temporal difference. Taxable temporal difference, whereby the carrying amount is greater than the tax base, and it leads to deferred tax liability. Another type is called deductible temporal difference, when the carrying amount is less than the tax base, and it leads to deferred tax asset, because it's a negative temporal difference. That is fine. So after you have known that that is how you are supposed to do deferred tax, then initially I could have mentioned that, but at the same time I can mention that we have two types of methods, or two types of methods which are supposed to be used in the computation of deferred tax. That is what I could have mentioned initially. So the first method is called income statement liability method, and So we have the methods of computing deferred tax, which is called, the first one we say that is income statement, liability method, income statement, liability method, income statement, liability method, and we have the balance sheet liability method, balance sheet liability method. So between the two methods, we said that the second one is the one which is recommended. The second one is the one which is recommended. So the income statement liability method views deferred taxes to arise from permanent differences. So this one views deferred tax to arise from permanent differences. And the second one views deferred tax to arise from temporary differences. That is why we used this route. So since we have said that the second method, balance sheet liability method, is the one which is recommended, and it views deferred tax to arise from temporary difference. You can see when I was saying that how you compute deferred tax, I said by that you take temporary difference times tax rate, then the other formulas follows. That is why we followed that route which I started with, because now balance sheet liability method is the one which is recommended, and it views deferred tax to arise from temporary differences. Unlike income statement liability method, which views deferred tax to arise from permanent differences. And I think we mentioned what are permanent differences and what are temporary differences. So with reminding you, we said that for the temporary differences, it's all about the differences. So these are the differences which arise. So these are differences which arise when an item has been considered in one profit computation, but ignored in the other profit computation. That is temporary difference. When I say it has been considered in one profit computation and ignored in the other profit computation, I talk about things like income. An income has been considered in the taxable profit computation, but ignored for the accounting profit computation. So we gave some examples. So certain types of expenses recognized in accounting profit, but ignored for tax purpose, e.g. depreciation, we have donation, directors' entertainment. Then I talked about permanent differences, whereby I would say that it's all about, it arises when an item has been considered in both profit computations, but in different time periods, whereby I used the aspect of the accounting concepts, the accrual concept and the cash basis concept. I said, e.g., expenses are recognized in accounting profit on accrual basis, while for tax purpose, expenses are recognized on cash basis. That is what we mean that an item has been considered in both profit computations, but in different time periods. Like now, expenses being recognized in accounting profit on accrual basis, while for tax purpose, it's recognized in cash basis. That is fine. So then we said that maybe if you are going to use an income statement liability method, we have three methods under that scenario: nil provision method, we have full provision method, and partial provision. So out of the three methods, we say that the one which is recommended is the full provision. And this is because this approach is all about, it makes provision for both current and deferred taxes, for both current and deferred taxes. But you can't find that income statement liability method is used. It's not common, because the method which is recommended is all about the balance sheet liability method. And I have to make justification why the balance sheet liability method is recommended, unlike the income statement liability method. So this is concerning that remember that when you are dealing with this method, which is called balance sheet liability method, it shows what? It shows the financial position of an entity. It shows the financial position of an entity. So unlike the income statement liability method, which only focuses on incomes and expenses, it focuses on incomes and expenses, which may fluctuate during the financial period. So that is why you find that the balance sheet liability method is recommended than the income statement liability method, because the balance sheet shows the financial position of an entity, unlike the income statement liability method, which focuses on incomes and expenses, which may fluctuate during the financial period. So up to that point, I think we can go and do a question of June 2012, question 2C, to illustrate more about these deferred taxes. So let's check this question of June 2012. So question 2C. So question 2C. So June 2012, question 2C. So this was the question. So it's all about Rami remittent has a deferred tax liability as at 1st May 2011. So this 1st May 2011. So this is all about 1st May 2011 of shillings 100 million. For the purposes of preparing financial statements, for the year ended 30th April 2012, the following additional information is available. So property, plant and equipment has a carrying amount of shillings 1.2 million and tax base of 1 million. Some land and buildings were revalued upwards by shillings 50 million during the year ended 30th April 2012. So intangible assets consisting of trade license being amortized over 5 years has a carrying amount of 60 million. This was allowed for tax purpose in full 2 years ago. So the company has available for sale financial assets with a carrying amount of shillings 20 million and financial assets at fair value through profit and loss of shillings 10 million. Both financial assets reported losses in fair values of shillings 2 million each as at 30th April 2012. Number 4, inventory is shown at the lower of cost and the net realizable value. The cost is 800 million while net realizable value is 780. Then number 5, receivables has a carrying amount of 500 million. After making an allowance for note debt of shillings 20 million and an exchange gain of shillings 40 million unrealized, both the allowance and exchange gain are not allowed for tax purposes. So are not allowed for tax purposes. So trade and other payables are stated at shillings 900 million after making provision for discount of shillings 10 million. So number 7, assume a tax rate of 30%. Assume a tax rate of 30%. So what we are supposed to do is all about to compute the relevant temporal differences and show the journal entry to record the changes in the deferred tax liability. So this means that for temporal differences to be computed, you know which method to use, which is the balance sheet liability method. And you know that in order to get this temporal difference, remember that you have to get the carrying amount, you minus the tax base. That it would be done. Then show the journal entries to record the changes in the deferred tax liability. So we'll make the relevant journal entries, because journal entries is all about debit and credit entries, which would be made around 3 entries, and we will be done with that question. So let us go to the computational part of this question. So now let us do the computation of that question. which is June 2020. So the first requirement that we need is all about temporary difference. So I will write in short, so temporary difference. So you know that temporary difference is equals to carrying amount minus tax base. So carrying amount minus tax base. So of which you know that in order to get the carrying amount, you have to get the cost, you minus accumulated depreciation. And in order to get the tax base, you have to get the cost minus capital allowance. Accumulated capital allowance, that is. So this must be accumulated capital allowance. So it's all about cost minus accumulated capital allowance. So capital allowance. Anyway, you know that is allowance. So that is fine. So which means that here I will come and write it was Rami Limited. So temporal difference. So that is as at 1st May 2011. So that is 1st May 2011. So after that, remember that we will be dealing with assets and liabilities. That is what we have in the question. So you might have the assets and liabilities. So the first column, we have to get the carrying amount. So CA means carrying amount. Then we have to get the tax base, TB, tax base. Then once I get my tax base, I will be able to get temporal difference. So we get that. So let us start from the first additional information. So the first information anyway, which is given. So the first information which was provided in this question, they said that property, plant and equipment has a carrying amount of 1.2 and a tax base of 1 million. So this question will be in terms of millions. So some land and buildings were revalued upwards by 50 million during the year ended 30th April 2012. So we talk about the property, plant and equipment. So the carrying amount is given and the tax base is given. That is direct. So property, plant and equipment. So 1.2 and 1. So that is 200. So you know that that is a taxable temporal difference. Carrying amount is greater than tax base. Then after that, we talk about intangible. We talk about intangible as the second one. Because they said intangible assets consist of trade license being amortized over 5 years at a carrying amount of 60 million. This was around for tax purpose in full 2 years ago. So intangible assets. So intangible assets is 60. So what about the tax base? What about the tax base? So there's something I need to mention about these intangible assets. We say that intangible assets are not assessed for tax purposes based on their tax base, rather on their carrying amount. So we always say that intangible assets are not assessed for tax purposes based on their tax base, rather on their carrying amount only. That is, their costs are always allowed in full for tax purposes. Their costs are always allowed in full for tax purposes. So, however, goodwill is tax exempt. That is, goodwill should not be assessed for tax purposes, even if the carrying amount exceeds the tax base. This is already what we mentioned in our previous classes. So that is why this one would be 0. So it would mean to be 60. So that is why you have said, I have said that intangible assets are not assessed for tax purposes based on their tax base, rather on their carrying amount. That is why I have just recorded 0 under the tax base. That is, their costs are always allowed in full for tax purposes. Even the examiner was very specific. He said that in note 2, towards the end, the last sentence, he said this was allowed for tax purposes in full 2 years ago. You can see he was very specific. So we are done with that. Note 3, the company has available for sale financial assets with a carrying amount of 20 million and financial assets at fair value through profit and loss of shillings 10 million. Both financial assets reported losses in fair value of shillings 2 million each as at 30th April 2012. So what you need to know here is that these are about financial instruments. This is all about the financial instruments. These are the 2 types of financial instruments. So which are assets? So the company has available for sale financial asset. This is the first one, available for sale financial asset. That is one type of financial instrument. And this is another one, financial asset at fair value through profit and loss. So on this scenario, we have 2 assets, which are a type of financial instruments. So I have to record them so that I look for their carrying amount and their tax base. So we have available for sale financial assets. So available for sale financial assets. And we have financial assets at fair value through profit and loss. Financial assets. So FA means financial assets at fair value. At fair value, right, in short, financial assets at fair value through profit and loss. Through profit and loss. So through profit and loss. So financial assets at fair value through profit and loss. So what about these available for sale financial assets and financial assets at fair value through profit and loss? So the relevant figures you are given there. For the carrying amount, you were told this. So the company has available for sale financial assets with carrying amount of 20 million. That is the first one. So this first one you are given 20. Then they continue saying. That under loss, and they say that financial assets at fair value through profit and loss, and financial asset through profit and loss of 10 million. So the first one, for the first one, their carrying amount is 20. So the company had available for sale financial asset with carrying amount of 20 million and financial asset at fair value through profit and loss of 10 million. So which means that the carrying amount of the second one is 10 million. And then they continue saying that both financial assets reported losses in fair value, that is in their fair value, of 2 million each as at 30th April 2012. So both financial assets reported losses in fair value. So for the tax purposes, in order to determine tax base, the taxman will add back those losses. So which means that this one would be 22 and this one would be 12. So it's all about increasing the carrying amount with those losses they recorded. So that is for the tax purpose. So which means that this will be 2 and this one will be 2. So we are done with that. Then the next item, either an asset or a liability, was concerning inventory. That is note 4. So note 4, they said that inventory is shown at the lower of cost and the net realizable value. So the cost is 800 million, while the net realizable value is 780 million. So this is very simple because you know that this is according to international accounting standards too, whereby inventory is measured at the lower of cost and the net realizable value. And we are looking for the carrying amount and tax base. And you know that carrying amount is not about cost minus accumulated depreciation. But the carrying amount, another name for carrying amount is net book value, which is the same as net realizable value. So which means that here we already have the carrying amount of 780. So because they have given us the net realizable value. Then in order to get the tax base, you know the tax base is all about the cost minus accumulated capital allowance. So since we have the cost of 800 and we don't have the accumulated capital allowance, so it means that it's 800 minus 0. So to get the tax base, you take 800 because it's cost minus accumulated capital allowance. So you have the cost, but you don't have the accumulated capital allowance. So which means that cost will remain to be the tax base. That is 800. So which means that here inventory, in order to record inventory, we have 780 net realizable value, which is the same as the carrying amount. Then this one remained to be 800 because that was the cost and there was no accumulated capital allowance to subtract from there. So which means that this will be 20. That one will be 20 because we take the difference of the two. Then after that, we move to the next thing. So we are remaining with around 2 additional informations and we'll say that we are done with the question. So the 2 additional informations. So the number 5, they say that receivables at a carrying amount of 500 million after making an allowance for doubtful debt of 20 million and an exchange gain of 40 million, unrealized, very important. So they have said that unrealized. So it's not realized, unrealized. Both the allowance and exchange gain are not allowed for tax purpose. Both the allowance and exchange gain are not around for tax purpose. So they are not around. So if they could have been around, we could have not been capturing them. Like now you remember they said under the intangible assets, it was around in full for tax purposes 2 years ago. So and we recorded 0. But this one, they have said it's not around. So we have to incorporate the 20 and the 40 when I will be getting my tax base. So let us record that. So this one concerns receivables. So for the receivables, remember that we already have the carrying amount. The carrying amount is 500, the one which is given. So the carrying amount is this 500 because they say the receivables had a carrying amount of 500. That is fine. Then now, in order to get this tax base, they say that there was 20 and the 40. there was something concerning 20 and 40, and they said that it was not allowed for tax purpose. So it means we have to incorporate that 20 and 40. So I always say that provisions we add back. This is the first one. Allowance for doubtful debt, the 20, you add it back to 500, and an exchange gain of 40 unrealized. So that one you subtract. So if it could have been realized, is when you add back, but now it's unrealized, so you subtract. So take 500 plus 20 minus 40, you get what? 500 plus 20, that is 520, minus 40.
480.
That is 480. So that is what we record as tax base. So that the difference is 20.
20.
And the difference is 20. Then finally, we can do the last one for the tax, for the temporary difference. We can do the last part. So the last part is all about trade and other payables are stated at 900 million after making provisions for discount of 10. So trade and other payables are stated at 900. So these are about payables. So they are stated at 900 after making a provision of 10. So we added provisions for tax purposes. The taxman doesn't consider that. So you would increase the carrying amount by that 10. So you will get 910. You get 910. So 910. So the difference there would be
10.
10. So that one would be 10. So it would be a positive because these are liability.
Yes.
So you are supposed to give me the total because we are already done with the determination of temporal difference. So give me the total so that we can get the deferred tax. So 200 plus 60 minus 2 minus 2 minus 20 plus 20 plus 10.
266.
So that is 266. So this is 266. So that is our temporal difference. And remember that that is a taxable temporal difference or a deductible?
Taxable.
Taxable. So taxable temporal difference leads to deferred tax?
Liability.
It leads to deferred tax liability. It leads to a deferred tax liability. So deferred tax liability, because that is all about, so we will get deferred tax liability. So in order to get the deferred tax liability there, remember that you have to take the temporal difference, which we have 266, you multiply with the tax rate. So in our question, we were given the tax rate in the last
30%.
addition. We were given in the last addition information. Assume a tax rate of 30%. So 30%. So 266 times 30%.
79.8.
So that is 79.8. So 79.8. So the next requirement, according to the examiner, you needed journal entries. Huh?
Yes.
So, but you cannot do journal entries without getting the relevant information to be taken there. So in order to get what I'm supposed to record in the journal entries, I would first do the deferred tax account. So this is what will guide me what I will be doing in the journal entries. So the deferred tax account. So the deferred tax account. So these are about deferred tax account. So the deferred tax account, remember that we have to start with the balance put down. So the balance brought down, according to the question, you were given a balance brought down.
100.
It was given 100 at the start of the question.
Yes.
So they say that the RAM Limited had a deferred tax liability on 1st May 2011, because that is the start of the year, ending April 2012.
Yes.
So 1st May is 100. That is where you are getting the balance put down from. So these are 100. Then balance carried down here is what we have computed, the 79.8. So that is what we have done. So I said that the only thing here which will increase this account or will decrease this account is concerning revaluation. So there was a revaluation.
Yes.
So we have to determine the deferred tax due to that revaluation. So you will increase this account. So deferred tax due to revaluation. So deferred tax due to revaluation. So remember that here, I can use this. So there was a revaluation. So there was a revaluation gain and a revaluation loss. So we have to net and get a total revaluation. So not 2 and not 8. Not 2 or not 1? Not 1?
1.
Not 1. So not 1, they said some, so there are sentences there, they say some rand and buildings were revalued upwards by 50. So we have 50. So remember that there was 50. That is a gain. So there's a gain of 50. And we have losses of. So we have some revaluation losses. Concerning this note, it was note 3. This one for the financial assets. So a company had available for sale financial assets with a carrying value of 20 and financial assets through profit and loss of 10. Then they say both financial assets. So there were two, both financial assets reported losses in fair value of 2 million each. So which means that there was a loss of 4.
4.
Because we have two financial instruments. So the financial asset at fair value and available for sale, and that is through profit and loss, financial assets. So you get a total of 4. So both 2. So a loss of 4, you minus 4. So you get a gain of 46.
46.
46. So you take 30% times 46 here.
13.8.
So that is 13.8. 13.8. 13.8. So the balancing figure,
34.
34, eh?
Yes.
So these are about to P&L. So this is a deferred tax income. So 34, because it's reduced. So the deferred tax for that financial year is reduced from 113.8 to 79.8. Eh? So that is by 34. So that is an income. So deferred tax income. So it was not an expense. So to P&L, to profit and loss. So what I will be recording in my journal entries is just these 2 items. So this one and this one. So what about revaluation? 13.8. So remember that revaluation, this one, I will debit my revaluation and it has been credited here. So credit deferred tax. So already it has been credited in this account. So where are you supposed to debit? Under revaluation account. The same with this one. So this one, it has been debited. in this account. So you say debit, deferred tax account. Where would it be credited? Under the income statement.
Income statement.
It will be credited under the income statement. It will be credited under the income statement as an income. So let us record that one. So journal entries. So for the journal entries, so you say debit and you say credit. So the first one I have said the concerning revaluation. So debit revaluation. So the 38. And then we have they have credited the deferred tax account. So the 38 or 13.8, 13.8. 13.8, not 38, 13.8. So that is one. And when you are making journal entries, you have to give narrations. So you say to record deferred tax liability due to revaluation. To record deferred tax liability. To record deferred tax liability due to revaluation. Due to revaluation. Then the second one I said about the 34, the deferred tax income. So they have already debited in the deferred tax account. So deferred tax account, the 34. So you will credit the income statement. So credit the income statement with 34. So you say to record deferred tax income. To record deferred tax income. To record the deferred tax income for the year. To record the deferred tax income for the year. So it means that up to that point we are done. We are done with that question. So since this question we are done with this question of June 2012. So we can read through the question of 2019, that is November, so that we can check something which was there. So this question of November 2019, question 5B. So it was the same question which we had already done. So it means that they did a copy paste from June 2012. So I need just to go through, then you will do on your own. So they say that Mafuta Limited had a deferred tax liability as at 1st October 2018 of shillings 400 million. So for the purposes of preparing the financial statement for the end of 30th September 2019, the following additional information is available. So number one, they say the company had available for sale financial assets with a carrying amount of 80 million and financial assets at fair value through profit and loss of 40. The same thing we did. So both financial assets are reported losses in fair values of 8 million each as of 30th September 2019. So inventory is shown at the lower of cost and net realizable value. The cost is 3.2, where the net realizable value is 3.1. The same was there. Receivable had a carrying amount of 2 million after making an allowance for doubtful debt of 80 million and an exchange gain of 160 million, and realized the same thing which was there in the previous question. So both the allowance and the exchange gain are not allowed for tax purpose. Trade and other payables are stated at 3.6 after making a provision for a discount of 40 million. You can see there's nothing they are changing, just they changed the figures. So property, plant and equipment had a carrying amount of 4.8 and a tax base of 4 million. So some land and buildings were revalued upwards by 200 million during the year ended 30th September 2019. So intangible assets consisting of trade license being amortized over 5 years at a carrying amount of 240 million. This was allowed for tax purpose in full 2 years ago. The same thing. Assume a tax rate of 30%. Assume a tax rate of 30%. So require the relevant temporal difference and channel entries. So you can see if you make your revisions well, some questions they repeat. Like now we're sitting, the question of May 2020, the sitting, there are sitting. So the question of reconstruction was a copy paste from the previous sitting. There was a question called to me. So when I will be doing that topic, I will show you. So concerning reconstruction, so the question of 20 marks, again, they went and copy pasted from a previous sitting. So they brought in the last sitting paper. So that is the last sitting, I mean, May 2021 sitting. So if you make your revisions well, the same with the lower sittings. Like now, another paper which I teach, the financial reporting. So the financial reporting, if you realize that there was a question of a conversion of a partnership to a company. So that question was for May 2014 again. So there was a copy paste from the previous sitting. So the same concept. So which means that CASNEP in some scenarios, they do copy pastes of questions from the previous sittings. So they don't have to create new questions, and there are many sittings whereby they can pick various questions and just adjust a bit and test in a certain setting. So this marks the end of the topic of accounting for income taxes, and that is what you need to know under the topic as a student. You need to know how to compute the relevant deferred tax and current tax. So for the current tax we did in previous video, I think already I shared that one, and whoever would be in need of the video would get for the question of current taxes. And already we have done for the deferred taxes, whereby under deferred taxes, I have used balance sheet liability method, and that is the one which is recommended. Nobody will ask you to use the income statement liability method. So according to International Accounting Standards 12, balance sheet liability method is the one which is recommended. So that is fine for that topic according to International Accounting Standards 12.